started, there's a couple of things we wanted to talk about. So first, you probably saw that there were a lot of things going on in the market, especially since the first of the year, and here in the last couple of weeks and days, even especially too. And so just want to take some time, as the invite said, to get together as a family and talk a little bit about what's going on in the market, what should you be aware of, what should you be concerned about, any changes, that kind of stuff. Before I get started though, I'd like to introduce, you'll notice one other person on screen with that Prairie View background. That's Bob Morvice. Bob has joined our team. What has it been, Bob? Now, a few weeks at least, huh? Or a couple weeks?
Couple of weeks.
And Bob is our Directors of Operations and a Senior Wealth Advisor. And Bob's been in the investment business for, I don't know, Bob, I'll let you kind of talk for yourself, but probably maybe longer than he even wants to admit. And comes to us, he is a certified financial planner, and is going to be a really seasoned person on our team. So, Bob, I don't know if you want to introduce yourself a little bit.
Sure. Hi, everybody. I just want to start off by just saying it's an honor and a pleasure to be a member of the Prairie View family. I'm very excited to get to meet and work with all of you. I come from, as Tim said, I've got over 26 years of experience in the financial industry. I was an options trader for a number of years. I do have my certified financial planning certificate. And as I said, I'm very excited on what Tim is doing and to kind of meet and work with all of you. So it's a real pleasure to kind of see a few faces tonight all at once. So I'm glad you were able to attend.
And I promised Bob that nobody would be too mean to him tonight. So the hazing will start at our second meeting. We won't do it all today. So as we get started tonight, I want to take just a couple minutes and lay out kind of what our picture is for how the meeting will kind of unfold. We've got, I don't know, it looks like roughly between 90 and 100 folks that have kind of logged in as part of our meeting tonight. And so we're going to go through kind of some remarks, just some ideas around what are we seeing in the marketplace, what should you be thinking about. I anticipate that'll take us maybe 15 minutes or so for some of the comments that we have, but then we'll open it up and we'll have time for us to have some conversation and some Q&A. As we do that, you'll notice, just to kind of walk through a couple of different options that you'll have. If you move your mouse down towards the bottom of the screen, you'll notice that there's a bunch of buttons down there. One of the options that you'll have will be to mute and unmute your microphone. And so right now I've got everybody muted, I believe. And so if you're going to want to ask questions when the time comes, you just feel free to hit the unmute button and you can speak to us. If you want, throughout the conversation, if you have a question, there's also a chat box there. If you click on that chat button, you can type a chat in there. And as you do that, know that that there's a way that you can have that go just to us, or if you're okay, the default is it's going to go to everybody. So just so you know, if you're typing away, if you don't change that, it's going to end up going to everybody on the screen will be able to see it as it comes up. So let's just kind of jump into it. So our picture right now is that as we look at where the market has been and where we think it's going, there are a handful of things that are participating in causing this volatility. So one of those things is, as you've heard, the Federal Reserve raising interest rates. So that is going to have a negative effect on the market. And what's causing that to be a little bit different this time, and I guess, let me back up, what do I mean by it? What's causing the volatility to be a little bit different this time than what we've seen in the past is that typically when stocks go down, you see bond prices go up a little bit because people start flocking for what we would consider safety. What's different now is that we're actually seeing bond prices and stock prices go down. And it's primarily because of what the Federal Reserve is doing with interest rates. And so when we talk about what they're doing with interest rates, as interest rates go up, the value of a bond comes down. The reason that the interest rates are being raised right now is when we look at inflation. Inflation is probably, from our perspective, the biggest concern that we have right now. And what inflation means is that we have prices going up, obviously, but prices are going up primarily because people are spending enough money, buying enough stuff, there's enough demand that prices are going up. The way that the Federal Reserve tries to combat inflation is by raising interest rates because it starts to slow down the economy. Inflation is a sign of an economy that's a little bit overheated. The reason they need to do that is if you allow inflation to go too long, it will actually start to cause a recession. And so when we think about the where things are at today, from an economic perspective, we actually feel pretty good about where the economy is at. We've got employment. People are virtually anybody who wants a job has a job. You see help wanted signs all over the place, and consumers continue to spend money pretty heavily. Inflation is our biggest concern. And what I'd like to do is to take a couple of minutes today and kind of talk through how is it that we're managing your portfolio and what are we doing to make sure that that we're kind of taking that stuff into consideration, making adjustments as needed. And so we've got is a slide deck here. Let me share my screen. Bob, I'm going to ask you if for some reason it doesn't come up right. Let me know if I start talking and nobody sees what I'm trying to show them.
Okay.
So what this does is this talks about our philosophy and how it is that we approach managing your portfolio. So, and as I get into this, let me kind of dispel a couple of things. A lot of times people are concerned about, is the market going to continue to fall? And what's going on with this whole thing with Ukraine, those types of things. So real quick before I get into that, the Ukrainian situation is a major situation. The biggest thing though is that it is a geopolitical event. It is not necessarily a stock market or a bond market event. The way that it is going to affect our markets and the portfolio returns is primarily through what it's going to do to inflation, more so than what it's going to do really to anything else. So in our perspective, we think we can kind of set that to the side from how does it affect how we manage your portfolio. When we look at, do we expect things like bonds to continue to go down? Our opinion is that the interest rate increases that the Federal Reserve is planning are already priced into the bond market. So our anticipation is that bonds will start to look more like the safe haven that they typically are, rather than see extended volatility there. From a stock perspective, we think we're going to continue to see volatility, but let's talk about how it is that we're managing money versus maybe some of the things you'll hear in popular press. So one of the things that we do, we talk about the 3 layers of managing risk. And what I like to do is I like to talk about what it means to be, pardon me, I got to let somebody else in here. So what I like to do is talk about a little bit around what does it mean to use quantitative analysis as opposed to doing what a traditional buy, hold, and rebalance strategy would do. And so the biggest thing is when you hear quantitative analysis, sounds really fancy, big words. All it means is we use data to make fact-based, statistically relevant decisions as opposed to utilizing anything other than facts and data. And so let's talk about what that means. So typically, when you hear somebody talking about being an asset manager, we like to use the expression of kind of buy, hold, and rebalance, or have a well-diversified portfolio type of a thing. And what we like to do is we like to think about that like a baseball field. And when you think about baseball, if you've got 9 defensive players on your team, typically you would have teams that divided their defense into even thirds. You'd have a third on the right-hand side of the field, a third in the middle, and a third over on the left-hand side of the field. What happens, however, is today you see a lot of defenses starting to shift, and they change the way that they play the game. And what happens is we do the same thing in how we manage your money. We're not adding players to the field. We're not changing the way the game is played, but we're using data to try to make smarter decisions. And so you'll notice over here in this side, you've got the same 9 players, but depending on who's coming up to bat, we'll shift those players to be smart about where we put our defense. So you'll notice in this example, we've got 64% on the left, 22% in the middle, and 14% over on the right. We can do the same thing with your portfolio. What typically happens in kind of that typical asset management strategy, that buy, hold, and rebalance type of a thing, what they're doing is they're always going back to even thirds around the field. By introducing some data and introducing the quantitative analysis piece, we can actually say, based on the facts that are coming in, how do we shift the defense and how do we change the portfolio to make a little wiser decision? And so the way that we do that, or the reason we do that, is our entire objective is to increase the confidence that you have so that you can hit your goals through using this kind of risk management strategy. What we find is if we change the objective to anything other than that, let's say we change the objective to, we want to protect our money at all costs. We don't want to lose a dime. Well, we're not going to increase the likelihood of hitting your goals because we won't make enough money in the good times to offset things like inflation that we're experiencing today. On the flip side, if we said we want to make as much money as we possibly can every year, we take so much risk that you potentially wouldn't be able to sleep at night. And so we have to balance that and say, what is the absolute best way for us to increase the confidence that we're going to hit the goals that you have in the way that we manage risk? And so let's talk about what those three layers are. The first layer that we look at is we look at what holdings do we pick and what's the process that we go through for choosing the underlying investments. The second layer, which is probably the layer that is going to make the most sense for tonight's conversation, is how do we put together the model? What quantitative numbers or what quantitative process do we use to put together your portfolio? Which is then number three, is how do we take the model plus the selections to build that portfolio? And we'll go through them kind of one at a time. So the first one is, let's talk about your holding selection. When we look at holdings, what we're talking about is the individual investments that you're holding inside of your account. So some of the questions that we ask ourselves are, what has the holding done as far as returns are concerned? How they perform compared to the peer group? What kind of pain did you guys receive or any investor receive during the last number of periods? Have there been attractive returns? Have there been really negative returns? And how do we balance between those two? The way we do that is we look at a number of different measurements. So the first one is we'll look at kind of what's the overall confidence rating of that investment. Things like, is it growing? Does it perform? You see something under like alpha. That is, does it outperform? Is it investing well? The experience factor. How much risk did I have to take to get the return that I got? And then how did it do compared to its peer group? When we're picking a holding, and you'll notice this just happens to be, let me go back up. This just happens to be the Delaware Small Cap Growth Fund. And you'll see all these dials just shows what that fund happened to be on this day. This isn't today's date. This is just a snapshot in time. But what we do when we look to choose investments is we look at all of those dials per investment to make sure that we're making the right choice in what we're holding inside of your portfolio. From there, we start applying those quantitative models, which are answering questions like, can we clearly define the strengths and weaknesses inside of the model? Are we comfortable with how much the trade-off is between appeal, which is we're going to make some money, and the experience, which says in order to make money, how much risk do I have to take? And will the model match or meet the goals that you have? And so let's talk through that a little bit, because there's a number of different models that we use. You'll notice over here, we have our level elements. So when you think about these elements, what they do is they take data and they look at it on 4 different series of math problems, if you want to call it that. So the first one is an economic level. Where do we expect the economy to go based on the data that's coming in today? The second one is trend. Where do we think the trends are telling us that the markets are going? We then have this volatility element, which says, how much is volatility kicked in and what should we be doing? And then we have what's called the contrarian element. Contrarian is, we're going to do the opposite of what everybody else is doing. And then we add to that some style elements. whether we want to be a passive investor, an active investor, or an active plus investor. So as we bring those components together, that starts to build the model of what we're looking to invest in. And so let's talk that through a little bit. Let me maybe unpack that for a minute. So in essence, inside of your portfolio, when we look at these different elements, it will tell us things like, we categorize it into kind of three different buckets. Should we be risk neutral, which risk neutral means that we have the amount of stock in your portfolio that we should for your given risk tolerance. So if you're a moderate investor, we have just a neutral level of risk in your portfolio. Sometimes these elements will tell us to be risk on. Risk on means we think the market's doing really well. Let's move our defenders, if you will, to the left side of the field and let's take some more risk. Let's go risk on and add stock to the portfolio. And then there's the piece that says, let's go risk off. And risk off says, let's take stock out of the portfolio. Now, as we do that, as you think about that, I'll walk through a little bit of what we've done with the portfolios over the last number of months. Going into November of last year, we were risk on. It meant we had more risk in the portfolio than what neutral would be. As we got towards the end of November, we actually saw that the markets, in our opinion, were heating up and that we went to a risk neutral perspective. We took some risk out of the portfolio. At the first of the year, we went to risk off and we took additional stock out of the portfolio. As of the last 4 weeks, we've made some other changes to the portfolio. We have not taken more stock out, but we have reallocated how we have that stock. So for example, right now, let's say not right now, it's in your portfolio right now, but the change took place two and a half weeks ago. We shifted from growth-oriented stocks, and large cap growth in particular, into some mid and small cap stocks, and we got out of emerging markets. So when you look at that, you might say, well, what does that do, or how does that affect the portfolio? It is in a sense, it's taking risk out of the portfolio. So it's a way for us to take a little less risk without going into bond types of holdings. Getting out of emerging markets, for example, lowers the risk. When you talk about going away from growth-oriented stocks are your stocks that are mostly technology-driven, those types of things. Those are the types of companies that when interest rates go up and inflation goes up, they take a beating typically. So it's a way to kind of mitigate some of the risk. So that's one way in how we look at the models and how the models help us to make some decisions. So then after we've picked your holdings, we've built the model, then we start putting the portfolio together. And as we do that, we look for things like, what are the strengths and weaknesses in the portfolio? How does the portfolio design set the expectations that we need? Will it reduce stress? And how does the portfolio enable us to be confident in the long run? And so as we do that, it starts to look like this. We start to pair specific holdings so that they're mathematically diverse, so that we have different data going into each one of those calculations. And you'll notice, this one says account one, we're looking at economics and trend, and it's a passive type of an investment. Compared to account number two, where we're looking primarily at volatility and being a contrarian, and we're managing that actively. And then at the bottom, we kind of blend all four of them and do that in an active way. And by doing that, it's geared towards specifically what are we trying to accomplish and how does that increase our likelihood of success? And so as we put that all together, it starts to look like this. It starts to look like we've got this holding selection process, the model building selection process, then the portfolio construction process. When you put them all together, that's how we try to get to the point where we are increasing the likelihood and the confidence of hitting your desired result. And so these are really kind of the three criteria that we're asking. Does the model portfolio, do those decisions make sense in context of the risk tolerance you have, the data that we have, the goals of your portfolio? Relative to stock and bond markets, have our long run risk and return characteristics been directionally accurate? We're not going to always get it right every time, but directionally, are we doing the right things that make logical sense? And are those long-term returns or long-run returns in line with what you need to achieve your financial plan? And so the reason we wanted to take a few minutes and walk through this deck, and I'm going to stop my share here real quick. So the reason we wanted to walk through that deck, there's a handful of them. First one is, in times like this, market volatility, it seems like it's pretty extreme, but as we look at where the market has been historically, we're actually in a very normal part of the market cycle. I like to think about the downturns as a very healthy part of the market. It's no different than your garden or your landscaping or any other part of life. You have to have times of pruning back in order to spur future growth. And so the way that we look at that is, this is just a normal, healthy part of the market cycle. I've got a question that came in that just said, hey, is this a good time to reassess your risk tolerance? So a short answer is no. Longer answer is, if there's been something that has changed inside of your life, then yes, we should be reassessing risk. So when I say things that have changed inside of your life, if your time horizon has changed, if you need some money coming in as an income and you didn't need income before, if you plan on making a large purchase in the next couple of years, those types of things, then yes, we may want to make some adjustments there. But as far as, in general, no, there's no reason from the market perspective to change that risk tolerance. I'll share with you kind of an example or a story as to what we see taking place inside of the market. So if I came to you and I gave you a credit card, and let's say that credit card had a $50,000 limit on it, and I told you over the course of the next year, I want you to spend that $50,000. What would happen is your lifestyle would go from here where it normally is to here. It would increase because you got $50,000 to spend. In essence, that's what took place when the federal government started all of the stimulus payments that were going out, because what happened was the economic impact was less than the amount of money they put into the system. So we ended up with like a cash infusion. It's almost like you've got this extra credit card money to go spend. What ends up happening with that then is, once that money runs out, just like that credit card at the end of the year, you end up having this much money to spend. Well, now you have to go back to what you used to spend because you don't have that extra credit card money to spend anymore. That naturally is going to slow down the amount of money that you have in your life, and your lifestyle is going to come down. Same thing is happening right now. As that money in the stimulus starts to run out, we will see things start to come down. Once that takes place, you have the second piece where now you have to start paying that credit card back. Well, when you have to start paying the credit card back, your lifestyle now goes from what it was down even a little bit further because you have this extra bill that's coming in. In effect, that's what inflation does. If you're used to going to the grocery store and buying $100 worth of milk, bread, and eggs every day or every week, now you have to go and spend $115 to get the same amount. You have an extra bill. It cuts down in the amount of money you can spend. In general, that is going to slow down the economy. As it slows down the economy, it could tip us into a recession. That's why you're starting to hear people talk about is a recession on the way. It's not because right now the economy is bad. It's because if we continue to have inflation and we continue to have raising interest rates, it is going to slow down our spending because we have extra money that we have to pay for these other things. That could dip us into a recession. At the same time, however, that a recession isn't always bad for your investments. And so it's our job, and what we're trying to do is to actively manage that based on the data coming in to adjust your overall portfolio to make sure we're in alignment with what we see coming. I had another question that got typed in the chat room that just said, hey, given inflation, is this a good time to put cash in the market or should you wait? Our perspective is, I don't know that we've seen the market bottom at this point. We may have, we just don't know that we have. And so our opinion is, if you have cash on the sidelines, we would start to dollar cost average it in over a period of time. We would probably pick several months so that you're buying a chunk along the way. We think that the market's going to continue to be volatile, and we think that it's going to probably go down a little bit more, but you never know when the bottom is. If you look at when when COVID hit, the market fell substantially in a short period of time, and almost just a short period of time rebounded and grew right back. And so our philosophy would be to take a measured approach. If you have cash on the sidelines, start putting some in a little bit at a time. So that's kind of our take on what should you be doing. We are still risk off. We have not started going risk on yet. There's some indications that would show that we might be leaning that way. No time in the next couple of weeks, but that the market is showing some signs that we may want to start going a little more risk neutral. And with that, I'm going to open it up. I've got a question here that says, hey, looking at our investments, we're directionally accurate, so thanks for what you're doing. Oh, thanks. I didn't realize you were going to say that. Thank you very much for the comment. And so let me kind of talk for that 1 second. When we talk directionally accurate, what you'll find is the likelihood of improving your chance of success is as much about limiting downside, trying to catch upside, but it's standardizing, or it is getting the right direction on your investments. Where you really run the risk of not hitting your goals is when the direction on that, or there's a misalignment with the amount of risk you're taking and what you're trying to accomplish with the way your investment strategy is. And that's why when we talk about we need to be increasing the likelihood or the confidence that you're going to hit your goals, it is not about how does it look tomorrow or a week from now. It is how does it look when I need the money. And as I look through and have scrolled through kind of all the folks on this list, most of you are young enough that you got a long time that you're going to need this money. And so it's not time to really panic and get nervous. It really is a time to look and say, is this still in alignment with what my overall goals are? And you notice I said most of you have a long time to go. I won't tell you what I'm looking at that I think you're closer to the end than some of the others. But as I look at this, everybody on this group is in a good position to say this is still in alignment with where my goals are and what I'm trying to do. And so there was another question that came in. If we're talking about dollar cost averaging into the market, kind of what time frame would we suggest that you do that? In our opinion, we would do it through the summertime. We would look between now and probably end of September, and we would be putting money in on a regular basis throughout that time period. So what I'm going to do, I don't know if I can unmute everybody all at once, but if you have a question, down in that lower left-hand corner of your screen, you can unmute yourself and feel free to ask a question that way. Or if you would rather do it through the chat, also kind of in the center at the bottom of your screen, you can click on that and kind of type in the chat. So I'll stop talking for a minute and see if we got any questions. Doesn't look like we have any brave souls.
Tim, this is Tom. I just have a general question. You did mention at the beginning of your remarks that the stock market is down and bonds are down. It sounds like it's pretty unusual. If people are taking their money out of stocks, they usually put it in bonds. They're not doing that this time?
Yeah, so what's actually happened with that, good question. So there is some movement towards bonds. The hesitation there has been because with interest rates going up, that's what's really driving that price down. Typically what happens though is markets are priced 6 to 9 months into the future. And so when we look and see what the Federal Reserve is talking about doing, all of those adjustments, in our opinion, are already priced into the bond market and are already priced with the declines that are there. And so, yes, as people pulled money out, there were a lot of people that went to cash. Some people that went into inflation-adjusted bonds, which I mean, right now makes some sense. But we're thinking that that's kind of bottomed out, and we'll start to see that those start to improve.
Okay, thank you.
Yeah. And so I got a question around DCAs or dollar cost averaging. So what that does, and I'm sorry, I should have been more clear with that. So what dollar cost averaging does is if you're already invested, then you would really leave, it doesn't pertain to you. If you have cash that you're waiting to invest, then what dollar cost averaging does is it says, I'm going to pick a number. Let's say I had $100,000 that I wanted to invest. I would look out over the course of the next 4 months, and instead of saying I'm going to put all my money in today, dollar cost averaging would say I'm going to put $12,500 in every 2 weeks for the next 8 weeks until I get all of my my $100,000 invested. So that if the market, we think the market's low right now, but it could go lower. So by putting in some today, I'm buying at a low point. But in 2 weeks, it could be a little bit lower yet. So I buy in a little bit more when it goes lower. But if the market ends up going up, say in the 6th week, now I'm buying a little higher, but I already have the increase from the previous 2 buys, and it helps to smooth out that buying process. Because is today the right day to invest that 100,000? We don't know. But by spreading it out that way, it gives you a better strategy for getting the money invested over that time period. And that's what DCA or dollar cost averaging kind of means. What else? Anybody else have any questions?
I have one, Tim.
Yeah.
Prairie View has placed my investments with Schwab Alliance. Are they using the same factors for investing to go in the right direction?
Yeah, great question. So let's talk a little bit about what Schwab does compared to what Prairie View does. So Schwab is our pardon me. Schwab is what we call our custodian. What the custodian does is they hold on to your money and keep track of sending statements and all that kind of stuff. Prairie View tells Schwab how to manage the money. We're the ones that are making all the decisions behind the scenes around what to buy and how to hold it. Schwab is the one that executes on doing that. So the analogy or the example I like to use is why do we use Schwab? If you remember back when Bernie Madoff had kind of stolen a bunch of money, the reason he was able to do it was because he was acting as his own investment firm, kind of like a Prairie View, where we're directing kind of what investments we're going to buy into, but he was also acting as his own custodian. And so when we look at changing how that looks, by having an outside custodian, it means that there is no way that we have any access to your money. We cannot dictate a withdrawal without your approval. All we can do is help to manage those funds. Schwab is really just acting as the intermediary, if you will, to actually do some of that investing and to do the facilitating of the transaction types of stuff.
Thank you.
Yeah, and I apologize. I'm trying to, it looks like my video cut out. I'm not sure why. So if anybody's typing anything in the chat box, I'm not seeing it. I think I might be back in here. So give me 1 second. Hey, there we go. Let me pull up the chat and see if I missed anything, if anything's there. I'm not seeing it. All right. Anybody else have any questions? Well, thank you. I'm glad we're able to get together. Thank you for tuning in. As I mentioned, for those that maybe joined a little bit late as we got started, I'd like to ask Bob Morvice if to kind of pop his head in a minute. So this is Bob, and we'll introduce him in a second. I just got another chat that came through asking about, what about retirement in a year and a half? If I'm thinking about retiring, should I be moving my money around? And our opinion is no. When you think about what happens is when you think about retirement, the day you retire kind of feels like a finish line. And really the day you retire is really the starting line. And so when you think about retiring in a short period of time, because it feels like a finish line, you get nervous about what about short-term market volatility. But when you think about the fact that when you retire, you're still going to need your money to last for at least another 25 years, maybe 30 years. That's a long time horizon. The market's going to do a lot of things going up and down throughout the course of that 25 or 30 years. So there's no reason to feel nervous if that time period of retirement comes up close. We need to manage your money. We need to be very careful with it. However, it's not a time to panic because it feels like it's a finish line. It's really just the starting line at that point. And so as I started, I asked Bob to kind of pop up and kind of introduce himself maybe a little bit. Bob, for those of you who maybe joined late, joined our team a few weeks ago, comes with a wealth of knowledge in the investment world and is a certified financial planner. So Bob, I don't know if you want to take just a minute and say hi as we wrap up tonight.
Yep. Hello, everyone who missed me in the beginning. As I said before, I'm extremely honored and excited to be a member of this Prairie View family. I'm anxious to kind of meet everybody and start working with you. I'm sure I will see you in the meetings as you kind of rotate into the office, and anxious to help answer any questions, help, work with you in anything that makes you help through your financial journey. And I'm, like I said, very excited to be here and working with Tim and his team. And
a little bit of personal background on Bob. He is married, has 3 kids in school right now. And, the neat thing is out of Bob's 4 kids, 3 of them all have their birthdays in the same month, which makes it easy. He and I share that. 3 of my kids, 3 of my 4 have their birthdays in the same month also. The difference is that mine were born all in different years and Bob's are triplets. So him and his wife in the middle of their first year of having triplets away at school and that kind of stuff. So yes, we on a personal note, yes, my wife and I have triplets that are sophomores in college, and we have a son who's a freshman in high school. So we're kind of rounding the bend, and they become a lot more expensive as they get older, I guess.
Well, good luck. Welcome to the team.
Thank you very much. I appreciate that, Tom.
All right, guys. Well, thank you. And that'll kind of conclude. I'll stay on for another probably 2 minutes or so if somebody has anything they want to bring in. Otherwise, we've got nothing else for tonight. We wish you all well and look forward to helping you live your legacy with confidence.